Hello, everyone. My name is Elisa Ewan, and I'm the Assistant Director of Alumni Relations at Teachers College. And I'd like to thank everyone for joining us today for the Alumni Career Development Webinar Series featuring Katie Hutto from the Office of Financial Aid here at TC. The webinar series covers a range of career topics and includes speakers from a variety of backgrounds. The series is co-sponsored by the TC Office of Career Education and Professional Development, as well as the Office of Alumni Relations. Videos of past webinars are available on our website at www.tc.edu/alumni/career-webinars. Today, the Office of Financial Aid presents Navigating Federal Student Loan Repayment After Graduation. The Teachers College Office of Financial Aid is available to assist students and alumni in obtaining the resources needed to achieve their educational and professional goals. They are aware that paying for an education may be one of the biggest challenges students encounter, and their mission is to help guide them through the steps necessary to become a successful graduate. Before we begin, I would just like to let you know that if you have any issues with the audio, please chat me directly in the chat box. And without further ado, here's Katie Hutto.
Hi, everyone. Thank you so much for joining us today. I'm very excited to be here, and thank you, Elisa, for the warm welcome. This is actually the first time that we've paired up with Alumni Relations for this specific webinar, so I'm very excited about it and really hope that it will be helpful to all of you as you navigate whatever federal student loan burden you're currently facing. My name again is Katie Hutto. I'm one of the assistant directors here in our Office of Financial Aid. By chance, I actually, in my previous life before TC, worked in a loan repayment assistance program. I'm also working through some of my own debt, so this issue is near and dear for several different reasons, and I'm excited to help you kind of gain some more comfort on this topic and hopefully gain a few takeaways that you'll be able to have at the end of today's session. So to provide a quick overview of a few different things to keep in mind at the outset, I do want to highlight that the Office of Financial Aid is again here as a resource for you. I'll provide our contact information at the end of the presentation. We are mostly organized by academic department to try and keep the workload fairly even. So typically you would reach out to the liaison for whichever department you graduated from TC with a degree in. I also want to reiterate that we'll be focusing specifically on federal student loans today. So there will be a little bit of information about kind of more general financial literacy strategies, but just to make sure that I'm sticking to what I'm very confident on, we'll really be talking about student loans rather than broader personal finance topics. We also won't get too much into private student loans, although those will be briefly mentioned just to provide a little bit of info on that topic as well. I also want to provide a disclaimer that any information provided here is accurate as of today, but may be changed in the future as federal policy in general is always subject to change. So this website here, studentaid.ed.gov, is always the best resource for the most up-to-date information on anything like loan terms, federal student loan repayment plans, forgiveness programs, and so forth. And your loan servicers are also available for support. Hopefully you have been in touch with them already. Also, as a quick note, I'll be keeping an eye on the chat. So if there's anything as simple as, oh, I missed that, could you please repeat such and such word? I'll be happy to take a pause in the middle of the presentation. But for the most part, we'll be leaving questions and answers for the end. So please be assured if you're typing in a question that we'll be sure to get to you and address any concerns that you have. So I wanted to start things off with a little bit of an interactive touch. So some of you may be familiar already with a tool called PollEverywhere. It's a live interactive feature that allows us to get some information from our audience, kind of get a sense of where you're coming from and what information you might be especially interested in. So just in case you're not familiar, this tool is something that you can either interact with via web, and we've provided the URL here. It's pollev.com/KatieHutto012, or you can also text in Katie Hutto 012 to the number 37607. And either way will get you signed on to answer a few upcoming questions that we'll use to, again, get a better sense of our audience. All of these responses will be anonymous and not linked to your screen name. So they're also completely optional, and please Don't feel pressured to respond if you have any discomfort, but hopefully you'll all feel comfortable sharing some information, knowing it won't be linked to you in any way. So without further ado, for our first audience question, I just wanted to take a general kind of pulse check. What are some words and phrases that come to mind for you when you think of student loans? Anything just kind of, gut reaction to get us started as a conversation piece. Frightening, yes. Okay, seeing some good responses coming in. I'm glad the tool is working. All right, I'm getting big sense of overwhelming. Definitely agree. Yeah, so definitely a lot of kind of negative, stress-related terms here. Overwhelming continues to be the big thing. All right, well, I think that we have a pretty good consensus here. So today's goal is really just to basically kind of make this entire topic a little bit less stressful, less overwhelming, less frightening, and hopefully kind of, reverse any uncertainty that you might have when you think about this topic and how to approach your loan servicers and your general loan repayment strategy. A lot of great responses. Thank you all so much for chatting in. So I wanted to provide you a quick overview of the different specific topics we're going to go over today, again, aimed at making sure that you feel less stressed out and less uncertain at the end of today's session. First, we're going to do a quick overview of some different student loan terms. I just want to make sure that we're all on the same page and that we all understand some of the basic definitions that I'll be using later on in the slides so I don't lose you too much with any jargon. We'll also talk a little bit about contact information for any loan servicers you've been assigned to and about all the different types of student loans out there in the world. From there, we'll move into some different factors you can keep in mind as you're creating a strategy for repayment. We'll talk about the pros and cons of various repayment plan options and some general advice that might help you think through which of those options is going to be the best fit for your financial needs and goals. We'll also go over specifically some of the federal loan forgiveness and cancellation programs. I know that's a big source of questions for our office and a big focus for general media attention and alumni interest. So hopefully we can get some questions answered today. Towards the end, I will also provide some resources that we hope will be helpful as you're moving forward and kind of thinking of some action items out of the webinar. And then as promised, we'll be sure to leave some time for questions and answers as well. All right, so before we get started too much further, I also am really curious to learn a little more about who's listening today. So I would love if you could please use that same interactive tool to let us know what year you graduated. If you had multiple degrees from TC, you can use whichever year you graduated with your most recent degree. Great, a lot of recent grads, love it. Give it just a few more minutes, a few more moments, sorry. All right. Wow, a lot of recent grads. Okay, great. Thank you all so much for tuning in. I'll also address some information about slightly older types of student loans, just in case you have any older loans from different degree programs or different degree from TC. So fear not if you're looking for information on things like FEL loans as well, but that's really helpful to know in terms of what specific loan types you probably hold from TC based on your graduation year. So moving on to some more relevant info, I'm also curious what types of organizations you all work for currently. So if you could please use the same feature to chime in. This is also going to be related to a lot of our forgiveness and cancellation discussions later on. All right, awesome. Looks like we've got a pretty interesting spread of people. So good to know. A majority here working at 501c3 organizations, but also some diversity across different types of entities in terms of where you're working currently. So that's great to know as well. And then our last of this little grouping of questions, also curious if federal forgiveness or cancellation is part of your overall strategy for ultimately paying off your student loans. All right, interesting. We've got perfectly divided audience, it looks like. So that's good to know. We'll be sure to give some general advice that works for people not pursuing forgiveness or cancellation as well. But I'm sure that some of you in that yes camp probably have some questions about how exactly to qualify for forgiveness as well. So that's very good to know. Thank you all so much for participating. This will help me definitely tailor the presentation a little bit more moving forward. All right, so as promised, we're going to start off with some basic terms. It sounds like there are some people in the audience who just graduated this year, so you might not actually be in repayment yet. So hopefully these terms are helpful just to establish the same foundation for everyone listening in. For those of you who've already been in repayment, potentially for multiple years, this might be already very familiar territory, so I won't spend too much time going over the terms. But here are a few definitions that I just wanted to make sure we're on the same page about. Just so you know, in the handout version of this presentation that will be provided after we're finished today, we'll give you more detailed written definitions as well, just for your reference. So the first one I wanted to start off with is interest. This might seem basic to some of you, but it's basically a percentage of your loan that is added on to the loan under certain terms and conditions and with a certain frequency, depending on what exactly the terms of that specific loan are. With any federal student loans you have, you're going to be looking at a fixed interest rate, meaning you might have a direct plus loan from last year with a 7% interest rate. That interest rate on that particular loan is always going to be 7% unless you do something different with it, like consolidate or refinance. On some other loans, especially in the private market, you might have a variable interest rate. So I highly recommend just making sure you know exactly where you stand on all your different loans, and also being aware that you most likely have different interest rates on each individual loan you hold. Related to interest is also a concept called capitalization. So what this means is at the end of your grace period after you graduate from school, or also at the end of some other periods such as forbearance, which we'll touch on in a moment, any interest that's accrued to date on your loan is actually added onto your principal balance and made part of your new principal balance. So ultimately, that's interest accruing on top of interest. Capitalization can really increase your long-term cost on a specific loan. You do have the option typically to make an early interest-only payment right before your interest is going to be capitalized. This is strictly optional, but if you have the ability to do it, that can be a great idea, as it again will decrease the long-term cost of your loan. Grace period, just to pause for a moment there, might be something that anyone who answered they graduated in 2019 is currently in. So typically after you graduate or otherwise drop below half-time enrollment, you get a 6-month grace period in which you don't have to worry about making payments on your loans. Again, at the end of that grace period, interest will be capitalized, so it can be beneficial to make some early optional payments if you have the ability, but you have that break where it's not legally required from you just yet. There are some older types of loans, such as the Perkins loan, that have longer grace periods, but typically on any you might have gotten recently from TC, you'd be looking at a 6-month grace period. During school, or if any of you are currently in a new degree program, you likely qualified for in-school deferment. So this is a policy under which for any federal student loan, if you're enrolled at least half-time in a degree-seeking program, you don't need to worry about making payments. There's also a related but slightly different borrower benefit called forbearance. Forbearance has the same effect where ultimately you can either pause your payments or significantly reduce them if you're approved, but forbearance is typically tied to more general economic hardship. It's something you would work with your servicer to request, and if you are approved for forbearance, then in terms of your credit reports, all that really shows is that your loan is in good standing. Typically, federal student loans do have a limited total lifetime amount of forbearance you can use. For most loans, it's going to be 3 years total over the course of repayment, but this is an option I want to make sure that you know you have. If there's ever a future point where you're laid off or you purposely plan some time in between jobs, anything else to that effect that can have an impact on your finances, you can always work with your servicer, and it's always better to set up forbearance upfront rather than just disappearing on a due date if you're having trouble making that payment. Repayment plan we'll talk about a lot more later on, but basically a certain schedule for paying off your loans that you agree to together with your loan servicer. That will determine what amount you pay per month and also how frequently you're billed and for how long you're billed. And then finally, delinquency is kind of the worst case scenario, so I hope this doesn't apply to anyone, but delinquency is basically the point at which you are so late on your loans that they're no longer in good standing. If you do end up in a point where you're facing loan delinquency, you can typically get into a rehabilitation program by working closely with your servicer. So it is possible to recover from this status, but again, if you're ever having trouble with making your payments, it is always better to talk to your loan servicer about your options than it is just not to make a payment when that payment is due. So hopefully these things all kind of are coming together. With that, we'll jump into more specific information that might be a little more new to people. But I do want to make sure, just in case this is new to anyone, that you know how to contact your loan servicer. I know as someone who relatively recently graduated from a degree program and also works in financial aid, I get a ton of kind of random seeming ads from organizations trying to get me to refinance or advertise something to me. It can sometimes be difficult to distinguish an actual official loan servicer communication from a company that's just interested in your business. So I want to make sure that you can always rely on the National Student Loan Data System to get an official record of the contact information for every federal loan servicer you have. This is the only federally authorized site where you can always count on getting current, accurate information for your servicer's contact info. So you can always go here. This might also apply if you have any loan servicers that have gone out of business or consolidated with a different organization. You can make sure that you're getting legitimate communications from whatever new servicer you've been assigned to. As one quick note on this page, please do keep in mind it's again only going to show you federal loans. We'll talk about how to locate any private student loans later. And then Perkins loans are a little bit special and confusing. These loans are federal, but they're ultimately serviced by the institution that gave them to you. So if you have a Perkins loan from a specific university, it is correct that that university will show as a servicer. Hopefully you've already been in touch with that account if you do have a Perkins loan from a given school, including TC. But if you're not sure where to go or you think you might be behind on payments for that loan, it's best to reach out directly to that school's financial aid office for some guidance. So now that we've talked about finding contact info for your loans, I also want to go over the different types of loans that it's likely you hold. For any students who have relatively recently graduated from Teachers College, you almost definitely, if you have some loans, would hold a combination of direct unsubsidized loans and direct Graduate Plus loans. So both of these types of loans are available to graduate students. They're not based on financial needs, so in combination, they're available up to your full cost of attendance. Some of you might have taken them out even for things like room and board and other education-related living expenses. These loans both have fixed interest rates, but each specific loan for each specific academic year has its own interest rate, which can be a little confusing. So, for example, for the 1920 academic year, the unsubsidized loan has roughly a 6% interest rate, and the Graduate Plus loan has roughly a 7% interest rate. Those two loans, if you take them out this year, will always be at that rate. But if you had loans from last year, if you take out loans next year, it is correct that you'll see slightly different variations from one loan to the next, even within this fixed interest rate world. Interest does accrue on both of these loans from the date of disbursement. So unfortunately, there are no subsidized loans available any longer at the federal level for graduate students. But for anyone with the ability to get a little bit ahead of that interest, you can always make early payments. The unsubsidized loan has a 6-month grace period, as mentioned earlier. The Plus loan has something technically called a post-enrollment deferment period, but it functions the exact same way. Both of these loans are eligible for public service loan forgiveness. Both of them are loans from the U.S. Department of Education, but you've been assigned to a specific loan servicer that's going to be your main point of contact in terms of any questions and any billing needs. The federal Perkins loan is something you wouldn't have received too recently, but you might have one from a little bit further back at TC or from a previous degree program. I believe the last ones were dispersed in summer of 2017, so it's been a little while, but not too long since they were last in effect. Perkins loans are given to students based on demonstrated financial need, and interest is subsidized by the federal government as long as the student is enrolled at least half-time. So if you did have one of these loans, typically a pretty good setup in that the interest is a little bit more favorable, with you not being charged interest until you drop below half-time or graduate. The Perkins loan also, as I mentioned really briefly earlier, has a 9-month grace period, so a little bit longer of a break after school as well before you need to worry about making payments. If you have a Perkins loan from Teachers College, the Office of the Bursar is actually the one that is kind of more directly involved in managing these loans for previous graduates. The servicer that our school works with is going to be My Campus Loan. If you have a Perkins loan from any other institution, that specific institution has probably picked its own servicer, so you can reach out directly to that school that you graduated from and ask them for a little more info on where to go if you don't already know where to find your Perkins loan. Perkins loans are unfortunately not available for public service loan forgiveness, but in a few slides I'll touch on some options that might be relevant if you do have a Perkins loan and you're interested in forgiveness. A few other student loan types I won't spend quite as much time on. You might have received federal direct subsidized loans if you were a slightly older grad from TC as a graduate student, or you might have received some as an undergraduate student. Subsidized loans are typically available based on demonstrated financial need, and they do qualify for public service loan forgiveness if they're direct loans. Parent Plus loans are unfortunately not eligible for public service loan forgiveness. This might not be relevant to those of you in the room since they're not typically available for graduate students, but it's possible maybe a parent of yours took out a Parent Plus loan to get you through your undergraduate years, or maybe even you've taken out a Parent Plus loan on behalf of a child of yours going through school. So these loans are made in the name of the parent, not the borrower, and they don't qualify again for forgiveness. And then one big tricky one that I do want to mention a little bit more in depth is FFEL loans. So FFEL loans are federal family education loans. This is a slightly older type of loan that was dispersed through June 30th, 2010. These loans are not at all eligible for public service loan forgiveness. Like the Perkins loan, you do have some options for potentially getting on track for forgiveness if that's something you'd like to pursue. But please just keep in mind that this can be a little tricky for any of you who were enrolled in a degree program before June 30th, 2010. This is one of the biggest pitfalls that borrowers fall into who think they're qualifying for forgiveness and never had the right loans to start off with. So if you do have any FFEL loans, it's not necessarily a problem, but it's just very important that you understand which options you do and don't have for dealing with that portion of your total loan debt. Private student loans really run the gamut in terms of the terms and conditions that one servicer to the next might offer you. They don't qualify, of course, for any federal forgiveness or cancellation programs, but it's possible that your private loan servicer might have some kind of income-based option or extended repayment plan option. So it's always best just to be in touch with that specific private student loan servicer to see what they might be able to do for you if you ever are having hardship with making the payments that are typically required. Loan consolidation. So this is kind of a tricky topic, but one that I want to make sure to spend time on for any of you who might have FFEL loans and or Perkins loans. So this can be a reasonable option for someone looking to get into forgiveness who doesn't currently have loan types that all qualify for forgiveness. The basic idea of loan consolidation is that it allows you to take multiple federal education loans and combine them into one new loan. Typically, you'll be offered a weighted average of the interest rates on any existing loans being consolidated. So weighted average, meaning they'll look at the balances you have at which specific interest rates and kind of combine all of those different things to make one new fixed interest rate on your one new consolidation loan. For that reason, if maybe you had some undergrad loans at an amazing, say, 3 or 4% interest rate from years ago, and you have some more recent loans at 7%, it might not make sense to combine those two, because while you might be reducing the cost of your grad school loans a little bit, you'll also be increasing the cost of your previous loans. That's completely up to you. There is a repayment estimator available at studentloans.gov, which we'll talk about a lot more later. You can also view the actual application for a federal consolidation loan at studentloans.gov. Please do keep in mind that since when you consolidate a loan, you're creating a brand new loan. If you've previously made any payments on those loans, they don't count towards forgiveness. So you're basically starting over at square one, at zero payments, if you do choose to consolidate. The reason that some borrowers might still want to consider consolidating, though, is that Perkins loans and FEL loans can be consolidated into direct consolidation loans, but you have to take that step, essentially, in order to get them to qualify for public service loan forgiveness. So that's an avenue towards qualifying for forgiveness. You do want to think carefully, though, if you're someone who, for example, is 7 years into repaying your Perkins loans by yourself. You might want to run the numbers to decide whether it's worth starting over on those loans and trying to qualify for forgiveness versus just going through those last 3 years of repaying them yourself. That really will vary depending on what your loan balances are and how long you've previously been in repayment. So your servicer should also be able to help as well. Again, just to highlight this, only direct consolidation loans qualify for public service loan forgiveness. There are also FEL consolidation loans out there. So please be sure you know for sure which type of consolidation loan if you have, if you do hold any already. There are also a number of private refinancing options out there. With any of these, I would just recommend that you really carefully read the fine print before refinancing via the private route. This would forfeit your eligibility for any federal forgiveness, but it sounds like we have some listeners who are working in the private sector or otherwise in jobs that might not qualify. So it's possible you might get an amazing interest rate offer on one of these loans. I would just encourage you to make sure you understand what the trade-offs are, though. So if, for example, you're thinking about ever going back to school, it might be really important to you specifically to know whether that private refinance loan offers in-school deferment, whereas for your friend who graduated in the same year, that might not be important to them at all if they're pretty sure about never going back to school. So it really depends on which pros and cons are important to you, but there can be some borrowers for whom private refinancing makes a lot of sense. Just be sure you understand essentially what you're signing up for before signing anything. All right, so hopefully this is all kind of a helpful baseline for what types of loans you might be coming in the door with. I want to talk next about more kind of the action item piece of all of this. Now that you understand which types of loans you're working with and you have a general sense of what your options might be, we're going to get a little deeper into your options for repayment and different strategies for making everything manageable. All right, so this is kind of the infographic portion of today's webinar. I do love infographics. I wanted to put together this slide to show you the trade-off between whether you're comfortable paying more per month or you really need to pay the least per month possible, and then kind of understanding what impact that has on the lifetime cost of your loans. So this slide, we're using a lot of different examples without forgiveness. That's important to highlight, so please keep in mind this is just to show you what would happen if you signed up for various repayment plans with various debt amounts and just plan to pay off that total amount yourself over the course of time. We'll talk a lot more about forgiveness a little bit later on, so this is really just illustrating short-term versus long-term trade-offs here. So with both of these different estimates, we're showing you someone who is a single borrower with zero dependents, who's starting at a $60,000 salary in New York State. Please do keep in mind that that it doesn't really get any more specific than state in terms of the formulas used to calculate income-driven repayment amounts. Typically, though, these repayment plans will use your adjusted gross income. So for a place like New York City that also has its own income tax, you might see a certain amount of an adjustment depending on the specific city you live in. Just not something that applies for every city, and that's kind of a whole can of worms we'll talk about a little later on as well. So this, again, is just kind of a straightforward borrower with a family size of 1, just trying to show you the general concept. We're also using on the left-hand side $60,000 of debt, and on the right-hand side $75,000 of debt to show you that this borrower has the exact same pay-as-you-earn repayment plan amount. per month, regardless of whether they have $15,000 more of debt. We'll talk a little bit later as well about how they cap the payment amount you're expected to make on various income levels. But I did want to illustrate that at a certain point, if you have a high debt to income ratio, having more debt won't necessarily cause you to need to pay more per month. So all of this is really just showing you that on any of these plans, if you sign up for something like the standard plan where you're paying a lot per month, it might be hard on a month-to-month basis. It might not be manageable for you, but it might be manageable for someone else in your graduating class. In the long run, any payment plan essentially with a higher per month payment is going to cost you less. So you can see on that standard plan amount, you save the most money by paying the most per month, which might not be a surprise. That's just kind of the trade-off that comes with the way that interest accrues over time. And I do want to highlight that there's not one right answer for everyone here. So on that standard plan, for example, with $60,000 of debt, it might sound really unmanageable for you to pay $700 per month if you're living in the city, paying rent, caring for others in your life, any of those numbers of things. You might, on the other hand, have a colleague or friend who's living upstate with low cost of living and says, that sounds great just to pay it off myself at $700 per month. So what you can manage in the short term is going to vary wildly from one person to the next, and that is completely fine. We just want to make sure we get you thinking a little bit about how much you can manage per month and what's going to be the best situation in the long term at the same time. All right, so on the same note, I also wanted to show you the general concept of how income-driven repayment amounts increase over time. I want to pause to say that there is actually a really helpful repayment estimator at studentaid.ed.gov. That URL is kind of right in the middle here, and we'll provide it again at the end. So if you're on this website, you can get really specific with different hypotheticals. If you're logged in with your Federal Student Aid account, it will actually populate your real loan balances. And you can enter different adjusted gross incomes, different family sizes, different states of residence, and it will get really specific about calculating a monthly payment amount for you, which is great. One thing I want to highlight here is that with any of these income-driven repayment plans, these can be great options, especially for borrowers with high debt-to-income ratios. But if you're signing up for one, you need to be comfortable with a certain amount of change. Because each year on any of these income-driven plans, you're going to need to recertify your financial information and recertify your interest in being on that plan. Unless you have exactly the same finances and family size from one year to the next, that means that over time your payment amount is going to change. So in this infographic at the right, we're showing you how this person's payments would fluctuate over time. I do want to mention that the studentaid.ed.gov estimator assumes a perfectly steady 5% raise every single year when showing these estimates. So some of you, especially already in the workforce, might know it's not typically quite that linear in the real world, but the general concept, I think, is helpful for showing you that over time, you can expect your payments to go up if you're in a field or career where generally your salary does increase from one year to the next. Marital status and family size changes can also impact your monthly payment amounts over time. We'll touch on why in just a moment. So with all of that being said, looking at the right-hand side of the screen, you can see that we're using the same example from the right-hand side of the previous slide. So this is a person starting out with a $60,000 salary in New York State and $75,000 of debt. Looking at year 20, it might seem a little scary to think about paying $1,000 a month, but do keep in mind that with this steady 5% raise schedule per year, this estimate is anticipating that the borrower will have about $150,000 of income per year by year 20. And then essentially, if this borrower ends up qualifying for public service loan forgiveness on exactly the kind of ideal 10-year timeline, their repayment schedule is basically going to be cut off at the end of year 10. So that specific person in that specific situation, again, would only ever reach about $690 per month. By that point, they'd be at, I believe, around a $90,000 salary. So with that said, we're going to get a little more specific about what types of repayment plans are actually available to you. The first one that I want to go over is the standard plan. Typically, if you don't do anything else to indicate that you're interested in another plan, this is the one you'll be signed up for, hence the name standard plan. The standard plan is basically just saying If you want to pay the exact same amount for 10 years straight and pay an amount that will get you to $0 at the end of exactly 10 years, here's what that would mean for you. So it's going to be a perfectly fixed payment, assuming you don't make any changes once you're in repayment. Typically, that is going to mean that for those of you with slightly higher debt amounts, the standard plan would offer the highest monthly payment in general. Kind of depends, again, on your actual debt amount, but it does tend to offer the lowest lifetime cost as well. So there's that trade-off again. Another benefit of the standard plan is that if you do really value predictability and it might stress you out to think about having your payment amount recalculated each year, with the standard plan, you can count on the payment amount staying very stable and not fluctuating with your income. The standard plan is technically eligible for public service loan forgiveness, but again, the idea of this plan is that if you stay on it for 10 straight years, you get to $0 at the end of 10 years. So in practice, you're not going to end up getting anything in forgiveness in terms of a dollar amount if you stay on the standard plan for all 10 years. For those of you, though, who might be kind of weaving back and forth between public service eligible high-paying jobs and public service eligible low-paying jobs, it might be the case that you're in standard repayment for a few years and then in income-driven repayment for a few years. Kind of perfect transition actually into the next slide. I wanted to show you all the different income-driven repayment plans that are currently eligible for public service loan forgiveness. Again, currently eligible, keeping in mind that things can change from the federal side. Not to worry, it doesn't change overnight all of the time, but you'll always want to refer to the federal website to make sure that you're seeing the most current information if you're referring to this recording at a later date. So two of the top plans here, Pay As You Earn, which is abbreviated as PAYE, not the word pay spelled wrong, and Revised Pay As You Earn, REPAYE. Both of these are typically going to be the exact same monthly payment for a single borrower. I want to take a moment to highlight the difference, though, because the Repay plan is the only PSLF-eligible income-driven plan that will take married borrowers' spouses' finances into account no matter what. All of these other income-driven plans on this slide, typically your spouse's finances only come into account if you're filing jointly in terms of your taxes. So you can, if it makes more financial sense for you, kind of avoid having your spouse's information taken into account by filing separately. So that's something to keep in mind for anyone currently married or potentially considering being married before the end of their loan repayment schedule. Otherwise, for a single borrower, typically both of these payments are going to be 10% of your discretionary income. Just to clarify for a moment there, when we talk about discretionary income, typically based on your adjusted gross income, your state of residence, and your family size, the federal government will say, okay, well, we think that X amount out of that total adjusted gross income figure is really what you need for basic survival purposes. The difference between that number and your total adjusted gross income is considered discretionary income, meaning the kind of the portion of income that they expect you can go out to eat with every once in a while, take trips with every once in a while. On any of these income-driven repayment plans, they're going to take a capped percentage of what's considered your discretionary income, with the idea being, above all else, to make your payment amount manageable, even if you do have a high debt amount, for those of you who might have lower and moderate incomes. Do keep in mind, again, though, that these payments will fluctuate from year to year if your income and family size are changing. Income-based repayment is another option you have for income-driven payment plans. Kind of depending on what loan types you have and what repayment plan you're signing up for exactly in this umbrella, you might be paying either 10% or 15% of your discretionary income per month. And then finally, income contingent repayment is, out of these four options, the one that would have you paying the most per month. This might seem silly to borrowers who are really confident they're going to shoot for public service loan forgiveness. For other borrowers, if you have any doubt that you're going to end up qualifying, some people feel more comfortable sort of hedging their bets in the sense that they're voluntarily paying a little more per month, knowing that if they do end up not qualifying for any reason, they will have still chipped down their debt a little bit more and gotten that much closer to a remaining balance that they can deal with if they end up not being able to receive forgiveness. Here are a few payment plans that do not qualify for PSLF. The graduated plan is one in which you're signing up for a steady increase over time. So you pay X amount for 2 years at a time, completely fixed. 2 years later, it increases to X plus whatever amount it'll take to get you to $0 balance at the end of your schedule. Essentially, over time, you kind of have this staircase situation where you're paying more gradually. This typically works for borrowers who are maybe in the private sector and anticipating they're not going to qualify for forgiveness. Also works best for careers in which you anticipate you're pretty predictably going to have your income increase over time. The extended plan can vary a little bit. You can sign up for either a fixed payment amount or a graduated payment amount with kind of the same staircase situation. Extended repayment can last for up to 25 years though. So if you're in a job that doesn't qualify for public service loan forgiveness, but you're still not earning a lot, this can be something worth considering, even though 25 years might sound a little intimidating. Typically with any of these income-driven plans, after either 20 or 25 years, depending on exactly what plan it is, there's also a time-based forgiveness option. So if you make it that long in repayment, but you're not in a specific career that works for forgiveness, you can have your remaining balance wiped out just by virtue of remaining in repayment in good standing for that long. The last repayment plan I'll touch on here is income sensitive. This is not a scary trap you have to be really worried about because it sounds so similar to the other income-driven repayment plans. I'm putting it on the non-PSLF-eligible slide because it's only available for FEL loans. FEL loans themselves are not eligible for public service loan forgiveness, so you don't have to panic if you have all direct loans about accidentally being signed up for this tricky other income-driven option. But do be aware if you do have FEL loans, if you're on this plan, even though it sounds so similar to the other income-driven options, that's not a payment plan under which you're making progress toward public service loan forgiveness. All right, so that was a lot of kind of specific detail about the different various income-driven options you have. With any of these income-driven repayment options, I wanted to give a friendly reminder again that each year you'll be required to submit documentation to have your participation in income-driven repayment recalculated and renewed. So you can see here, this is a screenshot directly from the federal site. It's required that you do this annually, but you can also submit documentation early if there is some kind of major change. So if you're working in New York City, making a certain amount, and you get an amazing professional opportunity moving to a place with much lower cost of living where you're potentially making less, you can opt into having your payment amount recalculated early for anyone who might be anticipating kind of a steep change for better or for worse in their income situation. This is, again, though, can't stress it enough, required to do once per year. Please make sure that you keep on top of any reminders if you're in income-driven repayment or interested in it. If you don't renew on time, you'll typically default back to standard repayment. Your unpaid interest might be capitalized again. And if you're on auto debit, I've had this happen to a friend. You might be very unpleasantly surprised by being auto debited for an amount potentially even hundreds of dollars more than you typically pay. So not trying to use scare tactics too much, but it is very important just to look out for any reminders from your servicer. Make sure you're sending in your documents on time for anyone in one of these plans. All right, so a lot of information on the different plans. I do want to make sure that we talk about forgiveness and cancellation as well. With all of these different programs, I'm basically taking text straight from the federal website, highlighting the important portions, and just trying to make sure that you understand it's all about knowing the fine print. I know especially with public service loan forgiveness, there's been a lot of scary stories about borrowers who thought they were making progress toward forgiveness and had actually been going down the wrong track for years. It is possible to qualify for all of these programs, I promise, but the most important advice I have for every single person listening, whether now or in our recording, is just keep very careful documentation of any contact with your servicer, and please just very carefully read the requirements on the Federal Student Aid site. There is a good bit of fine print here with any of these programs, but if you kind of check off all of these different boxes and you're 100% sure you're meeting all the qualifications, then you should feel pretty confident and pretty good that you're making progress toward repayment and potentially also forgiveness. So teacher loan forgiveness, with all that being said, getting into our first specific program, is for a very specific subset of classroom teachers working in low-income schools or educational service agencies. On the federal site, that studentaid.ed.gov one, there is a detailed directory of qualifying agencies, so I won't try to list them off here today, but please keep in mind this is, again, very specifically for certain classroom teachers. Teacher loan forgiveness also requires 5 complete and consecutive academic years of service. So it doesn't necessarily have to be the very first 5 years after school, but it does have to be complete and consecutive academic years. There's no flexibility on teaching for 2 years, working at a nonprofit somewhere else for 3 years, and then coming back. With teacher loan forgiveness, you also can only qualify for up to $17,500 total of forgiveness as an absolute maximum. This is, again, for direct loans and for federal Stafford loans, whether subsidized or unsubsidized. I did put an asterisk by the $17,500 because the forgiveness amount you can receive can vary based on subject area. So, for example, for some subject areas, you're actually only eligible up to $5,000 of forgiveness. That might be a significant portion of debt for some of you who have lower balances. Might not be that helpful for those of you with higher debt amounts. I say this because teacher loan forgiveness service years cannot be double counted with other programs. So you can't, for example, get to year 5 of repayment, receive $17,000 of forgiveness through the teacher loan forgiveness, and then continue right on another 5 years toward public service loan forgiveness. What you could do is get to year 5, have a portion forgiven, then start on your 10-year commitment to public service loan forgiveness. But it's unfortunately not quite that easy for those of you who might be both in eligible teaching jobs and in more broadly PSLF eligible jobs. The next program I'll go over but not spend too much time on is Perkins loan cancellation. So Perkins loans function a little bit differently than direct and FFEL loans in that they can be gradually canceled over time. So with every year of eligible service, if you qualify, your Perkins loan will have a certain percentage canceled out. This can be a good option for those of you who are maybe just serving for a short period of time in eligible employment, maybe not looking for a longer term 5 or 10-year commitment. Do keep in mind, though, it's specifically for Perkins loans, so it doesn't work on other types of loans. Perkins loan cancellation has a pretty specific list of job types that can qualify. So I've pulled out a few examples that might be relevant to TC grads, but there are a lot more examples out there that I didn't try to list in full. So if you're currently holding a Perkins loan and you'd like to see whether this might be an option for you, I would recommend that you take a look directly at studentaid.ed.gov for the full list of qualifying jobs. All right, I saved the big kahuna for last. So public service loan forgiveness is probably the most intimidating one out there, but it's also the one that can potentially allow you to qualify for the largest dollar amount by far. Public service loan forgiveness, as one great thing about it, is a lot broader about certain eligible public service jobs than something like Perkins loan forgiveness, Perkins loan cancellation, or teacher loan forgiveness. With PSLF, if you are working at a U.S. public school, for example, you can be an administrator, you can be a teacher, you can be the janitor. PSLF doesn't really care what you're doing. It's more about what type of organization you're working at. The important thing for PSLF is just that you're working full-time in that one specific job, or that if you're working combined different part-time jobs, you add up to a full-time equivalent employee, and each of the jobs that are counted towards that calculation would individually qualify for PSLF. Another both good and bad thing about PSLF is that it's a 10-year commitment, so 120 payments total, but within that it's important to understand that it doesn't have to be complete and consecutive years. So it's completely fine if you kind of weave in and out of qualifying for PSLF in terms of your employment and your payment plans. You just have to make it to 10 years total in some capacity. In case this is not clear enough already, I can't stress enough that you need to have direct loans to qualify for PSLF. If you do, again, have Perkins loans or FFEL loans, you have the option of potentially consolidating them, but that would be starting you at 0 payments on any loans you choose to consolidate. We went over the certain repayment plans that can be counted towards the required 120 payments. I also want to stress this on-time payments piece because it's not quite as simple as it might sound. So on-time payments, the obvious piece of this is that you need to make a payment at least within a week or so of the due date. The less obvious piece of this is not being in a paid-ahead status. So if you make too many optional payments towards your loans to make extra progress, you might be put into a paid-ahead status. That is not going to qualify, unfortunately, as an eligible PSLF payment because they're looking for payments that you're billed for that are legally required from you. If you are in a paid-ahead status, I would strongly recommend reaching out to your loan servicer to be pulled out of that if you're trying to qualify for PSLF. Typically, if you don't want to be in a paid-ahead status, but you do have the ability to make extra payments towards your loan, you might want to call your servicer each time you're about to make an extra payment and just get some help walking through how to apply it directly to your principal balance so that you're not thrown into this status that will kind of create some wrinkles with your participation in a forgiveness program. All that being said, I also wanted to talk a little about the logistics of applying for forgiveness. So one huge thing that I tell everyone I talk to about public service loan forgiveness is that this employment certification form at the bottom left here is something you're only required to submit at the end of 10 years when you think that you've qualified for forgiveness and you're in the clear. I would strongly recommend not doing that, however, because you can really submit this whenever you want. It's a great idea to submit this at least once a year, in my opinion, because as kind of one piece, it's always possible, especially for those of you working in smaller organizations, that a former employer could close, go out of business, you lose a contact there. You will need to document in some capacity 10 years of qualifying employment in order to qualify. So you want to make sure you're not going to have any trouble getting in touch with a former employer to document your time there. What happens every time you turn in this form is that the Department of Ed will go back in time, kind of match up your months of qualifying employment with your months of qualifying payments, and then come back and let you know, great, you have so far made 12 eligible payments toward PSLF. Once you submit your first employment certification form and it's reviewed, if you're not already by chance with FedLoan, you'll be transferred over to them because they handle all PSLF accounts. From that point onward, you'll see this nice little column here with currently the zeros and kind of the blank example document. But this column will update over time to show you how many payments you've made toward PSLF. This really takes out the guesswork, makes things a lot less uncertain for you, and you can have that official record that way as you're going forward to know how many payments the Department of Education considers you to have made so far. If there is any problem in, say, year 2, where you think that they've misreviewed a month or 2 of employment or something got lost or submitted incorrectly, it is so much easier to work on these things on a case-by-case basis while you're in repayment than it is to be struggling to document 10 years retroactively. So I can't stress this enough. Any of you working toward public service loan forgiveness, please just take a look at this employment certification form, which is available on the PSLF section of the Federal Student Aid site. Know that you can submit it really as often as you want once you're in repayment. As a piece of good news to transition toward the end of the presentation, I've also included on the right-hand side some qualifying. So this is pretty exciting. PSLF doesn't have a cap on the dollar amount that you can have forgiven as long as you otherwise meet all the criteria. So it can potentially be a very large dollar amount. I do personally know someone in real life who has qualified for public service loan forgiveness, so I can vouch that it's possible. It's just a little bit difficult to make sure you're understanding all the moving pieces. Just to make all of this a little more concrete, going back to our old friend, the example person with $75,000 of debt and a $60,000 starting salary, here's how things would look if this person ends up qualifying for PSLF at the end of 10 years. Having that 5% raise per year just for the sake of simplicity. You can see again that basically their payment is cut off at the end of year 10. They only ever reach a high of about $690 per month that they're paying out of pocket. And then if they qualify for PSLF in terms of total paid over the life of those loans, they actually paid less out of pocket than they borrowed in the first place. So in this example, the borrower ultimately pays a total of about $54,000 out of pocket, and the remaining $71,000 left at the end of year 10 would be forgiven via PSLF. So again, as you can see, it can potentially be a very large dollar amount. All right, so I am mindful that we're getting towards the end. I'm going to zoom through the resources just a little bit. So this will be provided again in a handout version, so you don't have to stress about jotting down the URLs right now. But I did want to make sure that you know where to find all the different sites that we've talked about today. And as one very quick last mention, if you do have any private loans, whether they're education loans or other loans, you can go to annualcreditreport.com to receive one free copy of your credit report once per year per each of the 3 agencies. Make sure that you know exactly where to find each private loan you might hold. All right, so I would love to hear any questions, if there's anything that people would like to know or would like to have clarified.
Hi, everyone. If you have questions for Katie, please feel free to submit them through the questions pane. And we have a few minutes for some questions. I just want to be mindful of the time. So if you do have a question, please submit it. We'll be happy to answer it. Of course, if you have more sensitive questions, in the next slide, we'll also show you the contact information for the Office of Financial Aid, and they would be happy to give you more advice on your specific situation. So we'll just wait a little bit and see if we have anything. So the first question we have, Katie, is can you have a break in service and still qualify for the public service loan forgiveness?
Yes, definitely. So with public service loan forgiveness, you just need to document 120 payments total that are made on eligible loans, on eligible repayment plans while you're working in an eligible job. It is completely fine if you work in an eligible job and make some payments for 2 years, then you go to a different job that doesn't qualify for 2 years, then you come back. You just have to make it to 10 years total within PSLF. So for someone in that situation, they might end up getting forgiveness at the end of year 12 post-graduation from TC.
Great. The next question is, what happens if I can't find a job after the grace period or deferment period? What are my options?
Yeah, great question. So I would recommend reaching out to your loan servicer, letting them know what's going on, and asking if they might be able to help you out with forbearance. Forbearance can continue to keep your loans in a status where you won't have to make payments just yet. Just reach out to your servicer towards the end of your grace period if you haven't already. Let them know what's going on. Say you're working on getting a job, but you just need a little bit of time. Typically, if you say, I don't have an income right now, I just kind of need a break, they tend to be pretty understanding about approving forbearance.
Fantastic. So we have a clarifying question. You had mentioned earlier when you consolidate your federal loans, it puts you back at 0 payments. Do you mean that the money you already paid disappears and you still owe it, or just means that the number of payments that you have resets back to 0?
Great question. So I meant the second one, and apologies for any lack of clarity there. So if you originally had, say, $20,000 of FFEL loans and you paid off $5,000, so there's a $15,000 remaining balance, if you consolidate, then the balance will still be that $15,000 that you've made progress toward paying off. But just as of the date that that new consolidation loan is created, you're starting at 0 payments towards something like teacher loan forgiveness, public service loan forgiveness, or whichever other program you might be aiming for.
Fantastic. The next question is, when is the deadline for getting certified for income-driven plans?
Oh, that's a great question. I always forget what exactly, basically your servicer will send a lot of communication about it. It's typically kind of right after tax season because the idea is that you're sending information about your adjusted gross income. And at that point, they're anticipating that you'll have your adjusted gross income finalized from the previous calendar year. So usually, I believe late spring. I usually just kind of get emails from my servicer and jump on it as quickly as possible. So if you are in one of these plans, they'll be very clear with you about the deadline. And if you're not currently in one of the income-driven plans, you can really reach out to your servicer at any point to ask for more information on how to sign up for one.
And so the last question we're going to take is, does working for a state government qualify for the public service loan forgiveness program?
Yes, so state government works completely fine, assuming it's a U.S. state. So any U.S.-based domestic government agency works great. It can be Federal, state, local, or tribal, just again, would typically have to be full-time, or if it's a part-time job, kind of combined with other part-time jobs that also work for PSLF. And then the studentaid.ed.gov page on PSLF will also confirm all of this. If you ever just want to see it in writing, it really does a good job outlining all the different eligible jobs.
Fantastic. So we'll go ahead and show everyone the contact information for Office of Financial Aid. In case you have any questions, please feel free to email them. They're more than happy to help you. And I would like just to take this moment to thank Katie. We really do appreciate you taking the time to share your expertise with the TC community. A video of this presentation will be available on our website. And again, that URL is www.tc.edu/alumni/career-webinars. Please visit our website for more information about our monthly webinars and upcoming events. We hope you can join us for our next webinar called Personal Branding, Consciously Enhancing What You Already Have, which will be on November 14th with alumna Linda Evans. Thank you again for all of you for joining us, and I hope you have a wonderful afternoon.